Today I'm going to show you how you can look at any property and tell if it's going to make a great cash flowing real estate investment. And I'm doing it by analyzing a deal that one of you sent me. This deal was sent to me by a BiggerPockets community member named Kevin, and he's looking to buy a property in Ferndale, Michigan. Never been there, but it is a suburb not too far outside of Detroit. And I'm curious to look at this one because Detroit is sort of a lightning rod in the real estate investing community. Some people think it's a great place to invest, others not so much. But in this video, I will look a little bit at the neighborhood, then we'll look at the specific deals. But first, a little bit about Kevin and this deal. So Kevin said that he is a first-time investor, and he actually lives in this area. So he knows the area well and likes the neighborhood. Basically, he's looking to finance this using a pretty conventional style loan, putting 20% down at 7.25%, which is what rates are as of this recording. The deal is a single family home on the market for $135,000. And Kevin is estimating, at least as of now, that he could get $1,350 per month in rent, which qualifies as the 1% rule. So I'm already starting to think that this is probably going to be at least close to a cash flowing deal. And as I pull up the listing here, I'll just explain to you, if you've never heard of the 1% rule, it's basically if you divide 1 month of rent by the purchase price and it equals 1%, you have a pretty good chance of cash flowing on that deal. And this deal equals exactly 1%. So that's a good sign as we jump into doing the actual analysis and looking at the real numbers here. So here's the listing on the BiggerPockets Deal Finder. If you want to use the Deal Finder to find deals for yourself, just go to BiggerPockets.com. You can check it out there. But let's just take a look at this property. Again, single family home. Siding looks a little old, but it looks like it's on a well-maintained lot. It's pretty small. So let's just see inside. Oh, the inside's actually quite nice. It looks like it's been recently renovated. Those are new cabinets, new appliances there. Looks like we've got some luxury vinyl plank floors, which is great if you're going to be renting this out. Really durable stuff here. All in all, the kitchen looks super nice. Could use some hardware in those cabinets, but not bad. Then we have 2 bedrooms, washer, dryer, stackable in the unit. Bathroom looks nice. Overall, this looks solid. And the thing that I'm looking for here before I start doing the numbers and the analysis is this property going to be rent ready, or am I going to have to put additional money into it to go in, renovate it, make it ready for a tenant? And from what I see for this property is that it's ready to go. Someone already flipped this house or renovated it recently. And that means that if I were to buy this property, I could probably rent it to a tenant almost immediately. I don't know if there's going to be vacancy, but I don't have to do a lot of work to place a tenant. And that's good. And we're going to come back to that in our analysis. The second thing I'm going to do here after looking at the photos is just look at some of the basics here. So this is a small house, only 712 square feet. That to me is a little bit of a yellow red flag. It's not necessarily bad, but it will limit the upside for rent if it's such a small place. But it's on a nice size lot. It was built in the 50s, so it's not super old, particularly for the Midwest, where sometimes you see properties that are like 100 years old, especially at this price point of 135. So that's actually pretty solid for me. The one thing I am noticing here, though, is this tax amount is high. $4,200 nearly for a property that's only worth $135,000. That is pretty high. So I am now wondering if this is going to cash flow, because that's going to eat into a lot of our income in the next year. Last thing I'm going to do before I start running the numbers is just look at this neighborhood. So first thing I'm going to do is just look at prices. So I can use this heat map and see that this area here in Ferndale is where prices start to go up. So I'm assuming that this is more of a desirable neighborhood, right? When prices are higher, that means that there's more demand. And you can actually see along this road right here where I'm moving my mouse, it looks like north of there, as you get towards, into Ferndale, into Royal Oak, that these are more desirable neighborhoods. But you are right on the border here is something that I would be looking at. Next thing I'm going to look at is forecast, which uses our data at BiggerPockets to tell us what we think is going to happen to prices in this neighborhood. And if you look at the heat map, it looks like it's going to stay about flat next year. That would concern me a little bit. We're going to look more into that. But you see over here, just to the west, and where in this area over here, it's expected to grow 5 or 6%. But where this particular block is, this property, it's lower, and that's something we're going to build into our forecast in just a minute. Last thing here is I do want to look at the crime map and see what's going on in this area. If you are used to looking at crime maps, it is not unusual at all to see red and orange areas, especially in downtown areas. but you don't want it to be, one of the highest crime areas. I particularly like to look at violent crime and make sure that there's not a lot of violent crime. It's not bad. Like, it's yellow here, so that's actually not terrible, but it's also not a particularly low crime area. Another thing we're going to think about as we do our analysis. The last thing is we do estimate prices at BiggerPockets, and this looks like it's going to be about $135. So the listing price looks pretty close to on, but let's go see if it's going to cash flow. First thing I'm going to do is just copy and paste my address in here. That allows the BiggerPockets calculator pull in some tax info, rent info, and then we can move on. So we're going to put in the purchase price. I'm going to just assume that we're going to buy it for full asking price right now. We might come back to that because it's been sitting on the market for a couple weeks. Maybe we can get it for lower. We'll come back to that in a couple of minutes. Our purchase closing costs are going to be about $4,000. And I am not going to be rehabbing this property because remember, it looked pretty nice. So there's no reason to put additional money into it. I don't think putting any more money into it would generate higher rents or really increase the value that much. So it's just not worth it. For property value growth, I'm going to keep this low at 2%. The average across the country is about 3.5%, but because of the maps and the way that it looked in that neighborhood, I'm going to assume that it's going to be a little bit below the national average. Hopefully, if I were to buy this deal, I'd be wrong and it would grow faster, but I like to be conservative when I'm analyzing this type of deal. So I'm going to put just 2% property growth on average going forward. Next, when Kevin submitted this, he said he was going to put 20% down at 7.25%. So I'm going to put that in as our loan. And he wanted a fixed rate for 30 years. That's all we need to do for our loan. We're moving quickly through here. Next, we're going to talk about rental income. Kevin thought that he could get $1,350. At BiggerPockets, we do have some machine learning that looks at rents and figures out what the estimated rent would be. And this actually says $1,464. So I'm going to start with Kevin's estimate because it's low and just do the more conservative analysis, but we'll dig into that more in just a minute. I'm going to open the BiggerPockets rent calculator and we can go into that in just a couple of minutes. Next, I'm going to look at expenses. So property taxes, this was the big thing I was worried about, is $41.78. That is expensive for this kind of property. Insurance would probably be about $1,000. I do own some property in Michigan. It's actually probably a little high. It's probably like $800, but let's just change it to 800. Repairs and maintenance, I'm going to put 5% in here. I'm going to put vacancy at 5%. I'm going to put capital expenditures at 5%. If it were an older house that hadn't been renovated, I would probably bump up those numbers, but assuming that they did a good job, and I would double check that before I actually bought this property, but assuming that they did a good job, I'm going to just put in about 10% for repairs and CapEx to manage this property going forward. And then because I am an out-of-state investor, I would put 8% in here. But Kevin said that he's going to self-manage this property. He lives in the area, and so that means that he won't have to pay the 8 to 10% property management fee that a out-of-state investor like myself would. Last thing is utilities, but since this is a single family home, we're going to leave these all zero because the tenant is going to pay that. There's no real need as a landlord to get involved when it's a single family home. So you just leave that there and let's finish our analysis. Okay, this is almost an exactly break-even deal as I analyzed it. -$3 cash flow is basically break even. So looking at the deals, just using the assumptions and analysis I did, I would not buy this deal for a couple of reasons. First, the break-even cash flow, not great. That can be okay if it's in a really good neighborhood and you're confident that you can cover your expenses and at least break even. I would consider it in a great neighborhood. This, from my little bit of analysis, does not look like a great neighborhood. And so the way I think about this is if there's low potential for appreciation, the cash flow I generate has to be higher. Like in this kind of neighborhood, I'd probably look for a 7, 8, 9% cash on cash return. If you're in a great neighborhood, I would look for, maybe break even, but probably more like a 2 or 3% cash on cash return to actually make this work. So that's what I'm thinking about based on the assumptions that I made so far. But as an investor, you have to remember that you don't necessarily have to offer exactly what they're asking for. So you can use this calculator to figure out if you can make this deal work. So one thing that I would do first is look at this rental income. Remember, the BiggerPockets estimate was higher than $1,350. So what I'm going to do is actually go over and move to the BiggerPockets rent estimator over here. And I'm just going to put in this address and see what it looks like. This was a 2-bed, 1-bath. We're going to see what the rent estimate is here. So we see here around this neighborhood that the middle is about $1,350, like we were talking about. for this neighborhood. But you have to look at the spectrum here. For properties that are in bad condition or is less desirable, they get about $1,000 a month. But the good ones get about $1,900 a month. And ours is recently renovated, so we might actually get better rent here. So I'm looking at this one here. This is a 2-1, 850, so also a small unit, a little bit older, and that listed for $1,450. That's the closest comp. We also see one a little bit further north, which if you remember was more desirable. So that's probably not our best comp. Even though it's a 2-1, that's 1,300 square feet. It's almost double the size. And so this 1975 is not a comp I want to use. This one might be good. 900 square feet, 900 square feet. You know, overall, honestly, I think 1,350 is probably about right. So I'm not feeling comfortable just looking at this data saying that I could get higher rent. So I'm going to keep this 1,350 where it is. So as of right now, this obviously doesn't look like a great deal, but a couple things that I would look at. First, talk to a property manager, because maybe they say, actually, you know, we operate in this area and you can get 1420, 1418 a month. That would get your cash on cash return up to 2%. Or maybe they say, actually, you can get 1485. Then that starts to look like an interesting deal. So you really have to double check your assumptions here, because that can change it from a good deal to a bad deal. And although the data is really helpful when you're at this stage of the analysis, talking to a property manager or people in the area or really diving deep on comps is the only way you can really know what it's going to rent for. So you'd want to double check that. But at this point for me, I don't know this neighborhood, so I'm only going to assume we can get 1,350. The last thing I'll do before I would potentially abandon this deal and move on is just consider what would happen if the seller would accept a lower asking price, because it's been sitting on the market for a couple weeks, not a really long time, but they might be willing to negotiate. So I would look at, hey, what happens if they would sell it for 125? Then we're at a 2% cash on cash return. So that's better, still probably not good enough. For me, the only way I would really consider doing this deal is if I could get the purchase price down to 125 and a property manager told me that I would get rental income of almost $1,500, then we're at a 7% cash on cash return. That would be pretty good, but that's based on a lot of assumptions. I don't know if the seller would take less than 135. I don't actually think we can get this 1485 for this place. I'm just trying to show you as an investor the things that you should be thinking about as you're analyzing deals, because you don't want to just base it off the assumptions that the first person tells you. You need to double check every single one of these assumptions before you make a decision on whether or not to buy a deal. All right, so that's it. Kevin, if I were you, I would personally pass on this deal. There's just too much risk and not enough upside for it. I do think the neighborhood that you're looking in does have potential, because it's sort of between a really nice and established area, and it could have potential for upside for appreciation. But the thing that's holding you back on this deal is the potential for rent. So if I were you, I would look for one or two things in the next property that you analyze. The first would just be a bigger single family home. If you get 3 bedrooms, 4 bedrooms, or just even more square footage, you're probably going to be able to increase rents beyond what you can get here. The other thing you can always look for is a duplex, because usually that will generate more rent and more cash per dollar that you put into the investment, and that will increase that cash on cash return and improve your overall performance of your deal. So that's what I would look at if I were you. But thank you so much, Kevin, for sending us this deal. Hopefully you all learned something about analyzing and looking for cash flow for rental properties in this video. For BiggerPockets, I'm Dave Meyer. Thanks for watching.